Okay, welcome back, everybody, and welcome to the penultimate panel of the afternoon. This one is Riding the Volatility Tsunami. Will leveraged credit markets continue to provide safe passage? And we actually came up with this topic probably 6-8 weeks ago, and if anything, the tsunami seems to have gotten a little bit worse since we originally came up with the topic. But I've got a very distinguished panel here with me this afternoon. I'll introduce them in a couple of minutes. Just a couple of housekeeping rules, just to remind everyone that this session is being recorded and there's the opportunity to submit questions, both for those of you in the room on the iPads and for those of you online through the Q&A box on the screen in front of you. So just to give a little bit of context first, to the discussion that I'd like to have with the panelists this afternoon. And actually I went on to Bloomberg earlier and just looked at some of the recent headlines, and I'll just read you a couple. Loan deals face pushback as prices sink. Volatility puts lid on new issuance activity. Nowhere to hide. In most sell-offs, investors can find a few safe havens, but against a backdrop of stagflation, rate hikes and a possible economic slowdown, nothing has been spared in the credit markets over the last few weeks. So I think it's quite an opportune time for us to have this discussion. Of course, we want to try and be optimistic and be upbeat. It's not all doom and gloom out there, and I'm hoping my panel will provide us with some enlightened insight and give us some reason and cause for some optimism. So let me just introduce my panelists. Starting firstly on my left, I have Fiona Hagdrup from M&G Investments. Fiona is a senior manager in the private credit division at M&G, and she's been investing in private credit for over 2 decades. And M&G is one of Europe's largest and longest-standing non-bank investors. Sitting next to Fiona is Aisha Narayan. Hopefully I got that right. I've practiced a couple of times. I'm getting close. Aisha, welcome. Aisha is a portfolio manager for high yield and syndicated loans at Hayfin. Welcome, Aisha. And then sitting next to her is Lucy Panther from Oak Hill. Lucy, welcome. Lucy is also a portfolio manager at Oak Hill for European performing loans. And then last but not least, right down the end, Colin Atkins from the Carlyle Group. Colin is a managing director and co-head of liquid credit and head of European structured credit. So thank you to my panel. So let's dive right in. And perhaps with my first question, just to get the discussion going, I'll get you all to make a few introductory remarks. Clearly, there's a lot of tension geopolitically in the world. There's the war in Ukraine. We've got soaring energy prices. As I mentioned, an inflation threat which, well, we thought was looming, now seems to be right on our front doorstep, and central bankers starting to hike rates. Hence, the credit tsunami that we seem to be heading into. The environment over the last 12 weeks has become quite volatile. So I'm very interested, and I'm sure the audience are, just to hear, at the moment, how are you navigating what is really a very different market environment than we've experienced for quite some time? And is there anything that's sort of keeping you awake at night as we head into this part of the credit cycle? So, Fiona, maybe I'll start with you first. How are you thinking about things in this market?
Well, first off, I suppose I should say that we all are long-only single asset class investors, so let's just acknowledge our bias when we are touting the merits of leveraged loans versus anything else. That said, of course, making a relative value comparison is always on minds. I think the short answer is one foot in front of the other, and with due humility, given all that's going on, all that we can't possibly know. We have been investing for a long time, and I suppose back to basics is also something that is more prominent or front of mind, meaning, is it enough for the risk, the adjusted risk that companies may be running. And while the confluence of circumstances that we have today may not have been seen for many decades and are unique in their own ways in any event, there are still some basic fundamental questions that attach themselves to lending to companies at first lien position in the capital structure as distinct from being junior or an equity holder. Most basically, of course, is it a company that is going to continue to exist even through difficult climbs? So I think if you can start with the very basic building blocks, like can it survive, can it service its debt and pay us back, i.e. not getting too blindsided or obsessed with the macro over which you can have very little control, but resorting to some of the granular bottom-up fundamental analysis that I'm sure everybody will say is their stock in trade, and being unafraid to pause, to say no. On the question of what's keeping me up at night, financially speaking, I'll spare you tales of my real life, but financially speaking is
stay on the topic.
And not to make light of a massive humanitarian crisis, by the way, but just financially speaking, on the portfolio that we're running, it's by far and away inflation risk and impact on the supply side shocks for what is, quite a large community of our world, meaning largely European private corporates. So all of the move into defensive businesses through the pandemic and food companies, and that, these are now the new areas of concern, let's say, from that perspective.
Okay, fantastic. Aisha, do you want to build on that?
Yeah, I mean, in terms of what we're focusing on, there's obviously a lot of different factors at play here, and it's a unique combination of situations as well. And probably to add to your list of issues, we also have China slowdown and supply chain issues as well. But we are focusing on relative value and optimization within the CLOs. So it's difficult. We've been active trying to trade, been pretty illiquid, the market has, both in loans and high yield. But where we see some sort of safe haven areas is probably on the TMT side, on the healthcare side, and more on the fixed rate side. And then, we can't call the bottom, but there are a lot of credits that are pari passu with loans in that space that are trading sort of in the 80s, in the low 90s. So there are opportunities to sort of rotate out some of those, some other credits and into some of those other more beaten up names.
Right, we're seeking relative value. Yeah.
Seeking relative value, exactly. And then I would also say the way CLOs are structured, I think it's actually quite a useful tool in markets like this, because you can take a bit more of a longer term view. It's kind of locked up capital. You're not subject to mark to market. So actually, as Fiona was saying, once you've done sort of your fundamental sort of credit analysis and you think, okay, at the end of the day, we do think these companies are going to pay us back, you can take, a bit of a longer term view rather than worrying about having to do the mark to market and have that stress necessarily. I would also say that at times of volatility, it's a really good opportunity because you're really seeing some proper price dispersion. So when the market's very hot, everything's sort of flying out the door, pricing's very tight, and there isn't that much differentiation in terms of credit quality and pricing. And we're obviously seeing a lot more of that now. So it's an opportunity, even though it's a little bit uncomfortable.
Okay, great. Lucy, new issuance activity is slowed down a lot. How are you making investment decisions when new issues do come to market? And are you also looking for those relative value plays that Aisha referred to?
I think that's one of the differentiating things between European and US CLOs, that you can do that relative value because we do have bond buckets, and so you can move from loans to bonds. And a lot of us were not fully utilizing our bond buckets before because of where bonds were pricing. And so actually, and bond buckets in general are somewhere between 10 and 12% for most CLO managers. So that ability to move from loans into bonds, cash can be the only hindrance there, where you have to sell a loan to buy a bond, but as cash comes back. So that enables you to sort of rotate your portfolio. And so we're doing that at the moment in relatively sort of not huge size, but in what we can do. And then new issue we are evaluating. I don't think new issue is easy. A lot of these deals were structured before, obviously before the sort of the sell-off in the market, and they need to come at deep discounts to make sense. I think some of the names were going to be challenging anyway, particularly where you are on, you know, potentially lower margin food, where you've got huge inflation or a lot of employees. And so we're looking at new issue, but you will see it come at deep and some at very deep discounts. And it's a long time since the capital markets have had to really take these types of losses. And I think they are slow to realize that that's what's going to be needed. And it's very much one deal in, one deal out. So they wait to see one deal price before somebody else is, quote unquote, brave enough to bring the next one. Everything is heavily pre-marketed, so that they try to have 60% sort of soft-circled or placed before they go to general syndication. But I think, you know, it needs to make sense versus where the secondary market is.
Yep, no, completely understood. Colin, what's keeping you awake at night? Anything?
Hopefully I've been around long enough not to stay awake at night for this stuff. But looking at a CLO structure, typically their economic average life would be 6 years. Most deals from the 13, 14 vintage, 15 vintage are still outstanding because they've been reset and what have you. So the point I'm making is that it's inevitable that there will be cycles within the time frame of a CLO. We're not trying to time the market. We're not trying to second guess what's going to happen. The structures, as Aisha said, the structures that are put in place are there for the long term. What you don't want to be doing is looking at your NAV in the current market environment. So that's the market value of the loans less the value of the debt of a CLO, because that's going through the floor. But ultimately, that's just a number. It doesn't actually matter. It's just a calculation. There's no pressure to sell positions. And certainly in this market, we talk about what's going on with primary. There is a chance to risk is clearly being repriced, and the number of repayments we'll get will be relatively low for obvious reasons, because the private equity machine isn't working per se. But it is a good time to actually build some par, take advantage of volatility where possible. Clearly the market isn't it's pretty illiquid secondary market. It's difficult to move too much stuff around. But I think just to say, oh, look at these headlines, isn't it terrible? It swings and roundabouts, and we'll be sitting here, or some people will be sitting in a couple of years, and there'll be a different theme and what have you. And if you look at the 2020 vintage CLOs, they look like some of the best that will be for many, many, many years. And you think the backdrop of that at the time. So it's not too early to say, oh, it's all doom and gloom, and who knows, it's an apocalypse is about to happen and what have you. We're getting Q1 numbers now, or most of the Q1 numbers are through. Generally, we're seeing for those credits that we're obvious ones to worry about, that inflation pass-through has been broadly happening. I think it's inevitable that won't continue, but once again, it's much, much too early to say CCC buckets are going to go through the roof by the end of June and defaults will be at 5% by the end of the year. We just don't know yet. So I think the message is tread carefully. The obvious issues are out there, but ultimately it's what we're paid to do, and we're just in a different part of the cycle than we were 6 months ago.
The other thing I wanted to add was, and this is a sort of the positive spin on it all, when you look at the type of issuance that we've seen over the last 3 years, our portfolios and all of our portfolios, I imagine, are actually relatively overweight sectors that are not necessarily entirely impacted by what's going on today. So healthcare, for example, or software, technology, business services, IT services. And that is because that's where private equity have been putting their money. Yeah. And so because we invest in it, and the majority of what we do is investing in LBOs. And so while the equity markets have obviously reduced the multiples of those businesses, I still think in a lot of the healthcare software companies, it is still an equity problem. And the numbers that we're seeing from healthcare, IT services, insurance, those numbers are still continuing to grow year on year. Some of the healthcare that was impacted by COVID is not if they were, the lab businesses, but that's already been impacted in the numbers. So to Colin's point, actually, there's a decent portion of our portfolios that really will do fine.
And to add to that as well, most of the obvious deals that are a worry today, whether it's food, energy intensive, inflationary, what have you, those were the deals that would have performed the best last year as the market snapped back. Nearly all of them, and certainly should have done if they didn't, have refinanced or would have refinanced last year. So we're not staring at any sort of maturity. There's a handful of deals out there, but very few that where you think, oh, there's a fundamental market issue here that's going to sort of fundamentally disrupt the market. So I think that's to the extent we're looking for positives, that would be another one as well. Okay, no, that's a really interesting point. So actually, what sectors are you looking at? I mean, I'm hearing from the far side of the room there that people are feeling fairly comfortable that, we're in some quite good defensive sectors, while equity valuations may be impacted, from a debt cap structure point of view, probably. But where are you, where are you looking to deploy new money?
So, I mean, I mentioned obviously high yield is quite interesting. I mean, so the European High Yield Index is 2/3 BB names. You don't actually have that many loan names in the BB space. So where you've had a rate sell-off, some names have sold off a lot more than they probably should have. There's opportunities there that are quite interesting. And then, as I mentioned, on the TMT and the healthcare side, it's also, there are opportunities to rotate. What I would say is actually on the private debt side of things, because Hayfin also has a private debt business, and that market, even though it's been quite sluggish on the syndicated loan space and high yield, obviously haven't had much primary at all, that market's actually still open. And over time, that market's actually moved towards a more cov-light sort of space as well. So we know that deals are getting done. You can probably get a 2 billion sort of size deal done. There's a talk of even maybe a 3 billion one done. It's in the works. So sponsors are actually going to an alternative market as well. Where there's a lid on sort of the size of the deal is, as I said, it's maybe 2 to 3 billion. Whereas if you want to do anything larger, you need to go to the syndicated market.
That's actually a very interesting segue. I've got a question that's just come up on the iPad here from the audience, which is, will growth of private credit continue and ultimately displace bank lending? What's your perspective on that?
So, it will continue to grow. I don't think it will displace bank lending because sponsors also need revolving credit facilities as well. And that's not usually a big money maker for the banks that are lending. So the sponsor community does need to provide fees to help finance and subsidise that to some extent. And I also say, as I said, I think there is a limit to how big a deal you can actually really get done. So when you really need to get a large deal done, you need a syndicate of banks to stand there and underwrite. Obviously, that's quite tough in this market, but I don't think it will be entirely displaced.
If you think what does a borrower want? They want cheapest possible funding. They want certainty of execution. They want a good quality investor base, so if they come back again, they want the loosest stocks possible and what have you. And there'll be certain points in the cycle where you obviously go to the public markets and certain points where you obviously go to the private markets. And what we're clearly seeing at the moment is a sponsor or whatever will look at the underwrite fees and the flex language that the banks are offering. And not surprisingly, in a lot of cases think, well, why don't I go to Hayfin, Carlisle, or whatever, approach them directly and just get the deal done with a small club and what have you. So that market is growing more than what you'd call the broadly syndicated market. There's absolutely no reason why both won't prosper side by side. I think what's clear is the private market's here to stay, and as time goes on, the size of deals seems to be less relevant as well. I wouldn't be surprised if, I think there's a sterling deal that's out there at the moment that's in the billions, but in terms of euro deals and then competing with the CLO market, it wouldn't be a surprise if 2, 3, 4 billion deals were getting done privately. As a broadly syndicated person, I don't see that as an issue personally. The market will move as it does and will continue to do so.
Yeah, I mean, we're just one part of a secular shift from public to private that I don't think will be derailed by a rising rates environment. So even though the ground covered by private debt funds, by the growth of private equity funds has been significant in the last 10 years, you know, any observer of investor allocation will tell you that it can continue. And just look at the size and the number of multi-billion companies either being taken private or homegrown from within private and staying private, integration or permanence of private equity in a firmament of infrastructure, equity and debt alongside corporate real estate finance. You know, these are still plate tectonics that are shifting. So I very much agree that while there's a significant room for growth within private debt, so there is in broadly syndicated, so there is in equity, so there is in real assets, private-wise.
Okay, thank you.
Yeah, the other thing I'll say that I thought was interesting was towards the end of last year, we saw a lot of refinancing of deals that were done in the private market during COVID that actually refinanced into the broadly syndicated market. And I think in general, it's fair to say that the broadly syndicated market will always be cheaper than the private market. And so when times are good,
we may see a repetition of that again, right? Yeah.
It wouldn't surprise me.
Yeah, no, I think that's a great point, Lucy. Fiona, you touched on an interesting point in your opening remarks around as rate rises go up and sort of effectively almost stress testing your portfolio, their ability to be able to withstand, you know, significant rate hikes. Can you just tell us a little bit more about that? I mean, we're at the sort of, and you were asking me on the way in, you know, are there any economists in the room, because you're not an economist, but obviously we could be at the start of a period of some significant rate hikes. To what extent is that actually a cause for concern? Are you stress testing, modeling that? Portfolio by company?
Yes, and I mean, you know, we can read up as well as anyone on what terminal rates are. We can infer that from the market and simplistically assess how companies are going to tolerate it. I would say, as earlier, that sort of modelling, particularly for euro-denominated, is dwarfed by margin erosion from input cost inflation. So even if for a second you accept that a 3-year euro swap rate of 2% is where we're headed, that's nothing compared to the hit. And then, of course, it's all about durability and for how long. And I think, you know, again, that's the misleading impression that looking top-down can give. Healthcare, but also scandal-strewn healthcare and tight labour markets in certain countries affecting wage costs for healthcare. And so similarly, within, you know, we're largely a single B community. The capital structures have been fine-tuned for optimal IRRs for private equity, and most things coalesce there, at least for, you know, CLOs. So, and within that, there's a myriad of outcomes possible. And just taking that lower sort of weaker B tranche, and the exponential way that things can deteriorate for some versus others. Again, I think it's definitely time to be forensic and not too big picture theoretical model, but really getting into the detail and understanding from management. So yes, so far so good on the Q1 reporting, but things are backward looking, and it doesn't matter.
It probably hasn't fed through yet.
Completely, right? And even if you've got a superlative track record with your killer brands that passing through costs and a demonstrable long track record, it's what's out there. And, management on the whole, still as uncertain as the rest of us. So, one has to absorb that and like I say, be humble about all that you don't know.
Are you in the forensics of your portfolio as well, doing deep dive?
More so than ever, also because the numbers that we have been fed for the last couple of years have quite a lot of inflation in them. And so the add backs that companies,
yes.
The thing that Colin, Asher and Fiona and I probably spend the most time on is when the analysts come in on a new issue and tell us this is what they think EBITDA is and this is what the company thinks EBITDA is. And then you spend a lot of time trying to bridge from our EBITDA to their EBITDA. But all of those add backs have been allowed. And so when you then look at the historical numbers that the companies are reporting, you've actually got to figure out what's real and what's not real. And so it is going back to what Fiona said of sort of old school work of cash is king. And actually what is cash? Because there have been so many adjustments and the docs are so loose that even the definition of EBITDA, you may think it's one thing, I think it's another thing, because what we've been allowed, that word has become so inflated to include so many things. And so I think all of us are really spending time on our companies and thinking about particularly those that are most impacted by inflation. We had a company yesterday that had 900 basis points of margin squeeze in one quarter, right? That is unprecedented. And obviously, if you can't start annualizing that, you quickly run out of cash. Now, they're claiming that they're backward behind on getting all their inflation through, etc. So a lot of
one-off, presumably, is how it's been positioned.
Yeah. But I have told to my distressed colleagues, their time is coming. Not all of these companies will make it,
No.
and there will be a pickup in distress. And so, yes, I think focusing on fundamentals is exactly what we're supposed to be doing, and trying actually to not, the macro is all out there, but actually just coming back to each of your names and just going through portfolio review after portfolio review.
Colin, I cut you off. I think you had a point.
On the interest rate point, I think it's the most over-discussed, least relevant issue for all of us. I'm sure everyone's aware, it's a floating rate product.
Exactly.
Euribor, 3-month Euribor today is minus 40 basis points. It's just not relevant. I'm obviously not suggesting interest rates aren't going up, but in terms of if we think about inflation, China, supply chain, whatever, this is a very, very distant fourth on that. And if I look back to the great financial crisis, so 07, 08, 09, Euribor was 5-6%, and spreads would have been 3% or what have you. And it's just a completely different model. It may be an issue at some point, but I think we've got many, 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 many more pressing concerns than interest rates for certainly the foreseeable period.
Okay, just a reminder to everyone in the audience and also online, if you have a question, please feed it into the iPad or on the Q&A box online. I've got a number of questions here that I'm going to come to in a minute. And just conscious of time, I want to make sure that we don't run out of time to talk about ESG, which has been incredibly topical throughout all the panels here today. And I guess the question, I'll maybe start with you, Fiona, and then I'll also ask Lucy to come in as well. can ESG continue to make strides in this kind of environment, or is it going to get lost to the side? What's your view? And I know, in particular, this is an area that you're quite passionate about.
Yeah, if not now, then when? I really think if there's some good to be extracted from a terribly difficult market global backdrop, then it's that. And even just trying to reduce it to our little corner of capital markets, loans are really simple at the heart. Like I said, we're just lending. We just want to know that you're going to pay back. And that means that, you know, your business model, your business should be sustainable. So, you know, just reducing it purely to the financial, it's another means of bolstering against that downside risk that we're all obsessed with. You know, it's a market of glass half empty folk. It helps that life is trickier in as much as those with true influence, the owners of the business. I mean, more stakeholders matter these days, happily, and debt holders are no longer shy about voicing what they expect. But if there is a financing negotiation to be held in a greater way than a more commoditized, easy market, well, then it's a time of influence with owner as well as companies. So the other thing I observe going on in our world is a better banding together. You know, we've all been conjoined by helpful institutions like the Loan Market Association, like ELFA, and we have our act together, I think. So no more can there be this sort of criticism of the buy side that they don't know what they want. They're all asking for bespoke things. Most of us are working in an environment of other asset classes. We can take a leaf out of, certainly on our side, what our colleagues are doing on listed equity. We can have more confidence in our own engagement with companies. The companies are bigger, as I mentioned before, meaning really there's less of an excuse, there's less of a haircut for a 5 billion EV globally present food business when we want to understand the supply chain and protections within it than, you know, a small mid-cap or a recently started entity. And after all, you know, the route, until recently, the route for most PE businesses might be to be listed one day. So better get in the foothills of what...
Right, get your house in order.
Investors demand, yeah. So I'm from that perspective, I'm daring to be a bit glass half full.
Okay. Lucy, push to the sideline or still front and centre?
Say it can, it must, and it will. I think, and I say that because whether you like ESG or not, it's being forced upon you. It's becoming legal. And so all of us have enormous ESG reporting requirements that we have to do. They're only going to get greater depending on who your investors are. And so, you know, we need to report carbon intensity now for a variety of our different funds and asset classes. And so we're starting doing that for all of our funds. And companies, you know, when you look, 1/3 of our companies now give us scope 1 and 2. 2/3 we're having to estimate for. But the level of data, the quality of data that we're getting is better and better. And this really is all about data. And businesses are beginning to understand that this data needs to be reported on an annual basis. And a lot of this is being imposed on us by the EU, by investors, by the UK, by TCFD, and all these other organizations and these acronyms that we're all having to sign up to. And so while I philosophically fully believe in ESG, it's also something that we legally have to do. And so I think that the quality of data will only improve, and our ability to engage with all our clients is improving.
Aisha, can I turn to you now? I've got a question here from the audience. It's actually switching back to the private credit question. Let me just read it. While syndicated loan pricing has widened, private credit pricing has remained largely flat. What do you think is driving this? And if there is a lag, how far behind is private credit from the syndicated market? What's your view on that, given that you've got a foot in both camps?
So, I mean, one of the main reasons it's widened in the syndicated loan market is because obviously just issuance has slowed down. Banks have deals, as Lucy said, that were underwritten in a very different environment. There's quite a decent number of deals that need to get syndicated. The CLO machine is a lot slower. You know, I think three deals priced in the last couple of weeks.
Correct. Yeah.
And it's not clear how many more are going to price in the next few weeks. So that machine has also slowed down. So there's kind of indigestion in the system. And if you want to, if banks need to shift risk, they need to widen out the pricing. So that, in my mind, is one of the main reasons. And then obviously the secondary market's also lower as well, both in loans and bonds. So the relative value of any primary deal has to be attractive in order to compete with those levels. And you just haven't seen that really happening in the private debt space. They've just kind of continued. I think they are probably quite particular about the types of businesses that they are looking at as well. So I don't think every deal could necessarily be syndicated in the private debt space. But that, I think, is a short-term kind of difference in the pricing of both markets.
Okay, thank you for that. You've all, I think, mentioned this relative value point between loans and bonds. And obviously you all have the ability to put 10 to 15%, I guess, depending on the CLO terms, into the bond market. There's a question that's come in actually from the online audience here. Have we reached the bottom of the high yield market in Europe? Is there more to come? That's a bit like that's a rather tricky question. But Colin, what's your perspective, and how are you thinking about it on this relative value play?
So one of the biggest differences between the bond and the loan market is the bond market is more retail, so week in, week out, inflows, outflows, and what have you, whereas the loan product is much more sticky, predominantly CLOs and SMAs and what have you. So the difference there is that we've seen significant outflows in the bond market, and that effectively means those that operate those funds to an extent are forced sellers, and that's what moves the market so much. And obviously, I mentioned earlier that interest rates for floating rate CLO and equivalent products isn't that relevant. Clearly, it's hugely relevant for the bond market if you're buying a long-dated fixed rate asset. Has it got further to go? It will depend on inflows and outflows. But what is clear is that the nature of the deals that are sort of priced at the start of the year, prior to all the inflation and war issues, these would have been bellwether telco credits pricing 10-year paper, what have you. So it's not credit risk that investors are concerned about when these positions are dropping literally 20 points. It's duration risk. I'm certainly not an expert on that, but certainly for CLOs, the product works very well. And it sounds horrifically simplistic, but you buy on weakness and sell on strength. As I said, we're not moving the market. We're just the recipients of the retail flows that are out there. I think a problem for a lot of managers, including us, is we're already pretty full on our buckets before the market really turns. So it's obviously there's very little repaying. So we're probably not making as much upside as we would have liked for that very reason. But I guess I'm not here to say whether they'll go up, whether those fixed levels will go up or down. But I guess the more interest rates go up, the more duration risk and the more they're likely to drop, which is probably why the prices are so low at the moment. One other benefit it does do, if you've got a structure with a fixed rate bond, an FRN, a floating rate note and a loan, it's pretty obvious if you can buy the bond at 80, then that will impact the trading on the loan and the FRN as well. So whilst they don't move in correlation, that does give opportunities where those loans, all things being equal, are probably priced on the secondary market lower than they otherwise would be.
Anyone else want to comment on that? Aisha, I know you had a perspective on this when we were talking.
It's a question we're asking ourselves every day.
Yeah.
It's like, I don't think you're ever going to find the bottom. It's hard to call the bottom. But what I would say is if you look at the iTraxx crossover, which investors often use it to hedge European high yield, that's like 440 basis points. And so over a 5-year period, that's actually factoring in a default rate of 32%, so around 6.5% a year, which is actually a really high number.
Yes.
So that would suggest that maybe things are, the market is viewing things in a very, very pessimistic way. And the only thing I would say is that the convexity on the upside, because obviously these bonds are call protected, etc. If rate views change, there's really going to be quite a rush in terms of where the prices go for a lot of these assets. And I think the market's also viewing things from a yield to maturity basis. And only in the last couple of days, you've seen at least 3 different companies being rumoured to be acquired by private equity, all having high yield or bond structures. One of them's rallied like 10 points, for example. So there will be some names that will also get acquired at some point, and there's some upside there as well.
So just conscious of where we are on time, and I want to give you all a chance to just talk a little bit about your outlook for the rest of the year, and generally an opportunistic, optimistic theme coming across from this panel. But maybe Fiona, I can start with you. I mean, outlook for the rest of the year, and I'm intrigued specifically, where do you see loan pricing getting to? If you had to crystal ball gaze a little bit.
Well, it's a bit like we were just discussing with the coming into line of broadly syndicated and direct lending. The transmission mechanism, whether it's touching the public markets because you need to finance there as a CLO, or within a company's cap structure because there are bonds, or even the loan market isn't all about CLOs. Even in Europe, there are open-ended funds, and certainly not in the US. You can't avoid the transmission mechanism that is the repricing of credit in public markets. So that's really the question. Are the days of printing stellar BB big corporate issuers in the 2s, or even below 2? Wasn't that insane that happened? But could, is that going to come back? Because if not, you're never getting those 10 points back. No. That you lost on duration. And I think there is a case for credit, IG, through high yield to be repriced somewhat permanently, at least for the foreseeable, as the narrative of recession risk becomes more real. We've all moved on from the it's only transitory narrative for inflation. It's going to permeate. To Lucy's point, not everybody's going to survive, and I think that there is a sort of collective reminder of the cost of credit in a more recession-strewn environment. So cautious, stick to your knitting and what you know, stay close to your companies, stay close to the owners you know and have observed over some period. Have a little look at what they have at stake over and above their pure private equity ownership. Isn't it interesting how the PE community itself has now become quite mainstream asset management, and what does that mean for their own reputational risk? These soft factors are going to be important to you when the companies that they own for the long term that you also want to survive over the long term start to struggle. So it's most definitely a time for reflecting on what you've picked already. Really, there's not too much shifting now. Liquidity is not amazing, and
no, it's hard to trade out of these positions even if you want to, right?
Yeah.
Colin, outlook for the year?
Probably more of the same. There's clearly going to the repricing of risk that's already started. It's difficult to see that not continuing going forward. Triple Cs will inevitably rise. There's no question about that. Default rates will rise. I think they'll still be probably lower than historical averages this year, just because it takes so much time for, if the issue is inflation, it's potentially happens relatively quickly, but it's still difficult to see those problems on those credits that are most likely to be impacted happening this year rather than next year. So yeah, I wouldn't say I'm optimistic, but I think what the market has learned from, say, the 15 years ago, the last big recession, is that we've got the right structure and the right products to navigate the issues that we're likely to have. And what I mean by that is that there's very, very little mark-to-market in the system, so we're not going to see this vicious cycle of prices down, sell, therefore prices down, or what have you. I think we've got the ability within reason to work through problems, but as we've all agreed, it's not like you can say, oh, I don't like this food deal, why don't I just go and sell it? Because there's probably very, very few people that want to buy it, or certainly at a price that would make sense. So it'll be a tough year, but I think I think next year could be more interesting, and certainly at this stage of the cycle in terms of reporting, we just don't know enough to know how acute the problems are going to be.
Yeah, I mean, it could be a good time for investing at some point, and you could have another vintage period to one of the
possibly, yeah,
earlier, right? Lucy, what are your thoughts on the outlook? And
I think it's going to be bumpy. I think it's going to be idiosyncratic, and I think it's going to be illiquid. You're not going to have a lot of new CLOs printing. You're not really going to have a lot of forced sellers either, and so I think it's going to be, and I think while dollar prices are low, let's remind ourselves when Aircom 208 is trading at 80, it's not really at a yield that's exciting to the next buyer yet. And because if you're the CFO of Aircom, you're going to keep that bond outstanding for as long as you can, because to Fiona's point, you're never going to get 208 again. And so that pull to par isn't going to be a huge snapback. So as much as the high yield probably don't like it, the high yield buyers, in order to get to a level that your credit ops fund finds attractive, you're probably in the 70s. And so I don't see, but why so I think it's just going to be a liquid, and from here we're going to be very idiosyncratic.
Aisha, you get the last word.
And I was just thinking about probably where loan returns would end up for the year. So we're down about 2.5% on the CS lev loan index, European lev loan index, and I was just sort of taking a straw poll in the office, and a few of my colleagues and myself, we thought we'd probably end up flat for the year. So as Lucy was saying, the CLO machine's obviously a lot slower, and it's not clear that there's going to be a lot of printing that's necessarily going to take place. There's still obviously a lot of warehouses out there that people, I think, are ramping reasonably slowly given just the uncertainty. But I also think underwriting banks, in terms of the sort of losses they're going to have to take on, given how difficult it is to syndicate things. We're talking about syndicating things in maybe at 90, even with an 80s handle. So that's going to put a lot of banks off underwriting large deals, and I think that means deal flow is going to be pretty constrained towards the end of the year. But that also means that there's less supply around, and I think that's going to mean that your loan returns will probably
and there'll be great opportunities.
Yeah.
Well, look, thank you to my fantastic panel, Fiona, Aisha, Lucy, Colin. Thank you very much to the guests in the room and also online. Thanks for all the questions. I'm sorry we couldn't actually. I've got a whole iPad full of questions there, but maybe for another time. Maybe we can reconvene this time next year and see where we've got to in terms of our predictions and so on. But we've still got one more panel coming up, the last one of the day, but please stick around and stick with us. The next panel is oil and gas, how geopolitical events are impacting the transition to a net zero world. So also very topical. So please, if you have time, please stay and join the audience. But thank you once again to my wonderful panel.